This is the Debunking Economics Podcast with Steve Keen and Phil Dobbie.
The Archives.
Episode 110. The growth of credit is slowing money down.
Welcome to the Debunking Economics Podcast with Professor Steve Keen. I'm Phil Dobbie. And today, well, a few podcasts ago, we asked why is money moving so much slower these days? The last few decades have seen a rapid slowdown in the velocity of money. Well, we wanted to revisit this quickly to spend more time looking at how the role of debt has been pivotal in this slowdown. And if that debt wasn't there, would the velocity increase? And therefore, if you believe Milton Friedman's equation, the economy would prosper accordingly. We'll look at all that today on the Debunking Economics Podcast. So let's start with that equation from Milton Friedman, the model that MV equals PY, money supply, and its velocity, the M and V, equals the overall price level, P, and real GDP, Y. So lots of money moving quickly can help GDP to grow, but it can also push prices up and cause inflation. But you, Steve, said in that last podcast that we need to factor debt into that equation because otherwise the formula doesn't stack up. And I guess that makes sense because the money supply has been up and down. The velocity of money has been slowing for decades, and there doesn't seem to be any correlation with inflation or economic growth. So is that why this formula has been largely ignored? Because it doesn't make logical sense to follow it because it's been disproven as it currently stands.
Well, to be leaving out a major causal factor, it's obviously going to go wrong at some point. If you leave out the role of credit as part of demand, then your predictions of what's going to happen when the money supply changes are going to be massively wrong. And my absolute favourite, and if anybody is working in a newspaper library in Australia can help me out, I would love to have them help me, because in 1987, back when the whole real business cycle model was dominant and people still believe in monetarism as well, a couple of Macquarie University economists published a large article, like a 1,000 or 2,000 word article in the Australian Financial Review, predicting that the rate of inflation in they'll start with their logic first, I'll end it with a prediction. They said because the money supply rose by 30% during 1987, and because the rate of real economic change was 3%, therefore the rate of inflation in 1988 would be 27%. They were wrong by 28%. It was actually minus 1%. Right. Okay, so what they did was simply take that whole argument about the rate of inflation being exactly equal to the increase in money supply minus the rate of real economic growth. They didn't understand credit at all. They didn't understand that credit was going entirely into driving up asset prices. In that same year, they'd ignored the fact that Australian share prices rose 80% between January and October of 1987. That's where the borrowed money was going into. And then when the crash hit and prices on the stock market fell by 25% in one day in Australia, that was the end of that particular bubble, and that demand just disappeared from the economy. People weren't borrowing any money anymore, so the rate of growth of the money supply also plunged, but their inflationary expectations are completely dashed. I would love to get a copy of that article. I had it, I cut it out and I lost it.
So by adding credit in there, you're basically just extending money supply. You're saying money supply is, the amount of money around is the money that's in supply plus the credits that's being offered to people. I mean, which could be a definition of money supply. I mean, the reason I mentioned that was because we got one comment from, we had a few comments actually from the first podcast when we looked at slow money. Mark Gorvin from Money Systems Transparency Alliance. Okay. Says, the velocity of money says it's just a wealth transfer. We're measuring the value in and out of each other's accounts, which somehow makes Fisher's velocity of money a misnomer. So he's basically saying Steve Keen, if you want to rebuild economics, you need to define basic notions and misrepresentations starting with a logical definition and specification of money itself, which has never formally nor logically been defined or specified, a fact that is simply unacceptable, he says. So there we are. I'm glad he got that off his chest. But I mean, it does get down to that. What is the definition of money? He's saying I think what he's saying is let's forget about the idea that money is hard stuff. It's money transferring in and out of accounts, which makes perfect sense. But if that's the case, wouldn't you also be including credit in that. So it became some of that, which gets to my point, is a definitely, are we adding credit into that equation, or are we really defining what the money supply is? Surely if we said the money supply is including that factor, because it's expanding the money supply. It's money that wasn't there before.
It's a very important point that we haven't properly defined what money is in terms of the general mainstream economic theory. There's no real definition of money in the mainstream. It's just these pieces of paper that fall out of helicopters. When the best definition of money was done by Augusto Graziani, and that's what I think that his definition of money is what really has let me build my Minsky software and the whole analysis of money that I've done since then. And that is that money, first of all, can't be a commodity. Because if you say money is a commodity, all you're saying is we're going to identify a particular commodity in a barter economy as the numeraire, and you're still working fundamentally in a barter economy. So in that sense, money can't be a commodity, and it can't be backed by a commodity. It must be a pure token. Now, if you have a pure token, then the danger is the person who creates the token can use the token to go shopping on their own front if they wish to. And that means that it can't be something which gives the person who creates it an automatic right of seigniorage. I'm talking in terms of a definition of a pure credit economy here, because of course the government does get that right of seigniorage in its own realm, and also that money can't be simply credit in the sense that if it's credit is a promise to pay, and it can't be if I promise to buy your microphone off you, which because I managed to leave mine back in London or Amsterdam, if I promise to buy your microphone off you, and I'll say I'll pay you back in X weeks, there's still an obligation between the two of us, a credit obligation, and therefore it's not actually money, because money is something you hand over as a final settlement of a transaction, and credit, a promise to pay a loan, is not the final transaction. So what Graziani said money has to be, given those conditions, is the promise to pay of a third party, which both parties themselves accept as being the transfer of the promise being a complete completion of the transaction between them. So I want to buy the microphone off you, and I give you a promise to pay of a bank to me because I've got $1,000 in a bank account, and I can say, I'm transferring the bank's promise to pay me $1,000 on demand if I wish to you. Then that is money. I'm transferring the promise of a trusted third party. And that fundamentally is what money is. The promise is to pay of a trusted third party in our now current monetary system are the banks. Now, so that's the definition of money that I think is quite valid.
And the fact that and the velocity comes into this, because the quicker you pay it, the quicker whoever's receiving that money can get out and spend it again.
Yeah, there's a turnover of that amount of money, but there's also, in that case, because the banks can because the level of banks' promises are not limited, the banks can promise more money, and that then becomes part of demand directly, because my analogy has always been, effectively mentioned, a stream going past. If you want to measure the volume of water in the stream, you take the cross-sectional area of the river and multiply it by the velocity of the water flowing through. So the cross-section is like the quantity of money, and the velocity is rate of circulation or turnover of that money. That's your VM equation. But at the same time, you've got a pump just before you measure the amount of money, which is either pumping water into the river or sucking it out. That's your change in money, change in water in that analogy, precisely equal to the change in money. So the total amount is not just the velocity of money times the amount of money, it's velocity of money times the amount of money plus new money creation, which then when it's created, it flows with the same speed as the rest of the stream.
So I'm still having difficulty here understanding what is the difference when a bank issues credit and is creating money. Why is that any different to just calling it the money supply in Friedman's model? Well,
it's because D times M doesn't give any room for M to grow. Okay, it's if you think about, I'll make an analogy with our own human bodies. You started off as a little bloke weighing about 3 or 4 kilos. Okay, your bone structure was generally speaking exactly the same as your bone structure today. How did you grow? The answer is there's a creation and destruction of bone tissue going on all through your life. Your body was destroying bone structure and creating new bone structure, so that over time there was a change in the amount of bone structure. So I wanted to measure you as a point in time. I would just say your skeleton is X. But if I want to actually accurately model you as a dynamic process, your skeleton is X plus dx dt. whereas the XDT is the rate of change, rate of creation of new bone structure. Over time, till you're about 60 or so, that's a positive. At a certain point, it sends a negative, and you start shrinking again. So if you just have the V times N, it's a static view of the nature of the economy, which would work if the economy is not changing in size. It is changing in size, and the monetary system changes in size at a rate exactly equal to the rate of change of debt.
But I mean, we are allowing for change in the money supply, but you're saying it should be we should be allowing for overall growth in the economy as part of that.
Well,
you're saying it's a static equation for changing economy.
That's what enables that change in the size of the economy as well, because again, there hasn't been an economy which has grown in physical output while it's been shrinking in the money supply. The money, because capitalism is driven as a monetary-driven system, Marx is like the driving force in capitalists is the desire of capitalists to earn a profit. And that's taking a certain amount of money and turning it into more money, MCM plus, as Marx put it. And that requires, when you look at it at the aggregate level, for to accumulate more money, you have to have a growth in the money supply as well. And again, to get a growing economy, that also the monetary system has to accommodate that, and that's what we've seen. So the total monetary demand, and I get this coming out of my Minsky models as well, it's the velocity of money times the stock of money plus the change in debt, which is identical to the change in money. So it's V times M plus the MDT.
Right, and that change in debt is obviously a bad thing in that it slows consumption. As we know, if that debt level gets too high, then people get worried, and so they start spending less.
That's the trap we get caught in. When you rely upon credit-based money system alone, then there's a couple of real traps into the economy which conventional thought doesn't get its head around because it doesn't see the role of money in the first place. So and this is why I think that it's so important to think in the way that accountants do about net financial worth. Your net worth can include, masses and masses of commodities you can accumulate over time, but your monetary worth is assets minus liabilities equals your equity. And when you have a pure credit economy, if you had an economy no government sector, just private banks, private money, and private money users, then because your asset is somebody else's liability, your assets minus liabilities equals equity calculation has an exact mirror somewhere else in the economy, where if your equity is positive, that of the other entity or group's equity is negative. The sum of all equity at the financial level is zero. So if you then inject banks into the economy, banks must maintain positive equity. We create a bank by getting capital together, money together, getting a banking license, wherever that might imply in the pure credit system I'm talking about. If imagine you've got a sort of a licensee of banks. So a bank starts with assets minus liabilities equals equity as greater than zero. That means the remainder, the non-bank economy in the aggregate, has negative equity. Now, at the same time, we're all trying to achieve positive equity. That is not possible. So that desire to get positive equity, one way that people try to do that is by two ways. One, they try to speculate. They buy assets and lever up the price of assets, and then they calculate their equity to include the value of the monetary value of the assets they own. And in doing that, they multiply the marginal price, the price of the last transaction that was done with that particular financial asset. They multiply that marginal price by the total sum of assets outstanding. And that's garbage. That is an error in the sense of if you tried to liquidate all the assets, the marginal price would fall to zero. But we do that and we believe we've got positive equity, but it's based on an asset bubble. Well, then we get caught in the Minsky world. Or if people try to save money to get positive equity, their attempt to save money, as we explained in another podcast, actually reduces GDP by precisely the amount that they reduce their expenditure. So we have a whole number of traps in a pure credit economy, and this is partly why we get ourselves caught in financial crises and periods of slump and austerity as well.
So I'm wondering whether we move this Milton Friedman model so far that it's just become so complicated it's no longer valid. Because if we say, well, okay, money supply and the velocity of that money, and then we start to add credit into that equation, those three factors are then going to determine the rate of growth for an economy, but also in inflation in the economy. Or as we spoke about last time, that inflation in the economy could be any number of factors which are not at all related to this equation. So does that mean, well, okay, we see inflation going up because of wage push inflation, therefore we need to increase the supply of money unless the supply of credit is low? It just gets rather complicated, doesn't it?
Well, it gets to be a complex system, and this is what I'm trying to bring about as a form of economic analysis. We have to acknowledge that we don't have an equilibrium system. We don't have a barter system either. We have a non-equilibrium complex system, and in that world, you've got to tie all these various causal factors together. And what you might think is going to work as a control system, as a direct control, may well have the opposite impact in the indirect sense. If you try to control as the government tries to control the economy by cutting its spending, and the belief that will reduce its debt level, that cut in its spending could actually reduce GDP by more than it reduces its debt, so the government debt level rises. So you have to have a complex system view of this, and the only way to systematically handle that is not to try to do it verbally or not to try to do it in an equilibrium set of calculations. You've got to have a modelling tool like Minsky, which can handle all those feedbacks and calibrate them and see what you get out of it, and then test run those policies you're trying in a dynamic setting, because, as you say, there are so many causal loops there. You can't just focus on one of them, and what the trouble is with most mainstream economics focuses on one or the other, leaving out the multitude of others and seeing how they feed back on each other.
But we do know that if we have too much private debt, particularly in an economy, then that is obviously going to slow down consumption because people are going to back off their spending, and so that hits the right hand side of that equation, where we start looking at the growth of the economy and the rate of inflation.
Yeah, that's going to hit it. So, and again, I can model that in Minsky. I can show those causal factors getting into play, and you can have periods of inflation and deflation, booms and busts coming out of that, and the simple idea that you control the economy in the way that Milton Friedman argues, just by controlling the rate of government money creation, as if that's the only factor, right, ends up suffering from the flaw of being non-oblique when we live in a very oblique world.
Right, but it is right to be in there, though. I mean, I'm taking your point that it's a complex system and this is a straightforward formula. It is an influence, though. The question is how much influence and what else is going on. But we should still factor it into the equation. So look, a question came from Glenn Lurley, who said when we first covered this topic, he asked whether we should draw a distinction between debt servicing the productive economy.
Productive economy, yeah.
And what falls into what he calls the financialized, which you'll love this, the financialized parasitic economy, that produces these ever-increasing paper claims on future wealth. So when we're looking in your modification of the equation, when we're looking at the level of debt, we should really be looking at the type of debt, shouldn't we? And what that debt is delivering to us.
Yeah, I had a bit of a chat with Glenn just by the email feedback on Patreon over this, and he's quite right that if you look at where the money actually circulates, that also has an issue on what form of inflation you get. So if you look at QE, for example, quantitative easing was directly creating money for the financial sector by buying bonds off them. And in the case of the UK, it was £200 billion per year worth of bonds. In the case of the United States, $1 trillion per year worth of bonds. So they were selling bonds at face value to the central bank, getting, let's say in America's case, because it's a round number, $1 trillion worth of cash out of that. The $1 trillion of cash doesn't generate any income, so they therefore had a motivation to spend that cash. And what can they spend the cash on? Because they're financial institutions, they must buy other financial assets. They can only buy commodities if they're buying a hedging operation on commodities. So they go and buy other financial assets, which of course drives the price of financial assets. Now when they do that, of course they've got to buy the assets of somebody else. So if they buy the shares off shareholders, then that process drives up the price of shares, which can make the people who sold the shares use the money they've got to buy more shares, or they can use that partly to go shopping, and you get the odd Lamborghini purchase and somebody to clean the Lamborghini for you, and you get a dribble of money into the real economy. So QE causes massive inflation in asset prices, but very little change in the real economy. On the other hand, if you look at mortgage debt, when you buy a house off somebody who is is levered to the hilt, and you get even more to buy it off them. So there's an increase in the monetary price of the house. then that monetary increase, the price writes off the debt of the previous owner, and they've now got net cash which they can spend in any way they like. They again tend to go and buy more houses, but they'll also buy white goods to fill that house, various things for the trophy partner and so on, and that can lead to more of an overflow of that mortgage debt into the real economy. So that's one reason I think mortgage debt plays more of a direct role in causing economic booms and slumps in the real economy than shareholder purchases do. But yeah, it does actually have an impact. Where does the money actually circulate? And I want to basically be able to cover all of that in my Minsky models in the future.
So it's looking at the productivity or the marginal productivity then, isn't it, of debt, not treating all debt the same. What is the productivity of that debt?
I hate the word marginal productivity, but yes, I do agree with you. That's the question of where does the money go, what impact does it have in which particular market, and then how much do those markets interrelate with each other. So all these factors are things you can actually put together in a dynamic model and tune properly. And that's what my Portuguese PhD student Pedro Pratas is doing with an incredibly sophisticated model of the Portuguese economy, where he's including the existence of finance markets, the existence of property markets and so on, and the government money creation, the laws allowed by Portugal's membership of the euro, the level of credit creation and so by the private financial sector, what's happening exports and imports, et cetera, et cetera. You've got to put all that together, and you need a dynamic framework to do it. And again, I'm going to tout something like Minsky is the only way to go about it. And that's why economics has to think about these things not just monetarily, but also dynamically.
Yeah, because it's a complex system, which sort of answers, Indeed. You've sort of answered a question. It was something that came in on Twitter after the first podcast on slow money. At Menganito said, he called you a debt vigilante, first of all, and said...
Oh, that's not bad. I like that one. Thank you.
I don't think he meant it in a positive sense. He said...
Oh, dear.
He said, people acquire debt precisely to spend. No one borrows to put money under a brick. Well, I mean, your point, if it's something where you're buying something and it's in the consumer space, then that is absolutely right. It's just when it falls into the financial sector, might ultimately find its way out. It's just going to take a lot longer. Hence, the speed of money slows.
Yeah, but it's also the question of the timing of people doing that borrowing. If you have people tend to get into debt during a boom and have to reapply it during a slump, and you have the boom itself causes a change in the distribution of income, so the borrower's expectations about the money they're going to have to service that debt in the future are not going to be met, and therefore you get cycles and the tendency for that debt to ratchet up over time, which we have seen empirically. So I'm always coming back to saying I'm quite happy to be called the debt vigilante, because we don't see the impact of that on the long run trend for the economy and the long distribution of income and the long run effectiveness of money. And those have all come back to bite us very badly in 2008. So I'm quite happy to be called the debt vigilante, because I think we were in fact attacked by a debt bubble back in 2008, and nobody else saw it coming, but certainly very few economists saw it coming.
Now I'm looking at a chart here on a website called thebalance.com, which has looked at the velocity of money this century, since the year 2000, or I think it's 1999, in the United States. It starts at 2.09. What they've done is they've taken the GDP and divided it by the M2 money supply. So nothing terribly sophisticated, but that gave us 2.09 at the start of the century. It fell to 1.96 after those attacks on 9/11. It fell to 1.9 when George Bush reduced the capital gains tax in the United States from 20% to 15%. It fell to 1.7 when the Dodd-Frank Act was introduced, making it easier for banks making it harder for banks to lend quite so much. Well, certainly curtailed them a little bit. So I wonder if these events matter, or should we just look at the fact that the general direction is down, in fact, down to 1.4, so from 2.09 at the start of the century to 1.4 last year.
I think that's, again, a combination of the level of debt, meaning people are trying to save money to pay the debt. By trying to save money, they're reducing the rate of circulation of money and GDP falls as a response, and you get a decline in the velocity of circulation of money as a feedback of that. I would love to get back to the levels when the value is actually closer to 3, which is the level I use informally in my models. And I think the fact that it's as low as it is just because we have this massive debt overhang. So and the higher the debt hang, the longer the debt overhang lasts, the less people are willing to turn over the money they've currently got, and the lower, effectively, productivity of money we get out of the whole economy.
And are we measuring the right thing? I mean, could we be saying, well, okay, this is the velocity of money is slowing. If we measured it in another way, I mean, I'm just wondering if have we got the definition right? Because you know what and maybe we have, but you know what I'm asking. Sometimes you can be so hell bent on looking at something that's declining, but if you measure it in a different way, you might actually find it's fairly stable.
Well, in fact, there's actually three major definitions of the velocity of money. One's related to M1, either M2, and the other the money of zero maturity, which is the one I prefer to use. It's a concocted,
which is also going down,
which has been going down since 1980. And I think that's the real reason to say it's not just a recent set of events that have led to this, it's the increasing level of leverage since the 1980s that have caused that.
So, okay. So I think we've sort of answered the question, have we? Have we covered enough of this? The fact that it is debt that's driving this? What have we missed out of this equation?
I think we've covered we might not have satisfied the first poster's comments, because I think there's going to be questions about how they define money which differ from me. But it's showing we've got to consider the only way to understand the whole damn thing is put it together in a complex system vision. The reason I can articulate what I have is because that's how I started in economics, and I've designed Minsky to take that further, and I've learned a hell of a lot by actually designing Minsky about the role of money and its impacts here. And that's when I'm talking verbally, I'm often articulating what I've seen running in one of my models on this front. So we've got to make thinking about it as a complex system the de rigueur way to think, not ignore it.
Yeah. And in that complex system, if we get to the point where debt starts to level off and people start to deleverage, does it therefore follow, conversely, that the speed of money, the velocity of money is going to increase?
Yeah. Again, if we massively delevered, I think we would find that velocity increasing quite radically. And that's what I'd like to bring about. I think if we actually could abolish large parts of the debt using government money creation capability to do it, drastically reduce the debt burden, that would reduce people's desire to hang on to money to try to pay the debts that they no longer have. And with that, we'd have a higher rate of circulation of money coming out of it.
Right. And then the government wouldn't need to keep on creating quite so much money as a result. That's
right. I mean, we could get out of this trap by realizing we're in the trap to begin with. And one of the problems is we don't realize we're in a trap, and we're trying to get out of the symptoms where something we don't understand the cause. And that's never successful in medicine, and I don't think it's going to be successful in economics.
Right. Okay. And the answer to all of that is the cause is it is a complex system, but clearly a big influence in that is the amount of private debt that's being held.
The influence is being left out by mainstream thinking, which is why they're so wrong.
Yeah. All right. Very good. Thank you, Steve. We'll catch you again very soon.
Okay, mate.
And I love that comment from Glenn Lurley that I read out earlier, that the banks that are giving us these loans that are building up this debt are part of, quote, the financialized parasitic economy that produces ever-increasing paper claims on the future wealth, which I think is a good topic, actually, for a future podcast. Maybe we'll do it next time. Just how are we killing productivity, future productivity, and growth with loans that were previously paid for there and then? Like, for example, student loans. The government used to pay, now students carry the debt. So what impact is that having on the economy? You can probably think of lots of other examples as well. We'll look at that next time. If you have thoughts on that, get them in very quickly, and we'll include your comments on the next podcast. And that is it for this time, the Debunking Economics podcast with Professor Steve Keen. I'm Phil Dobbie. I'll see you again next time.